Now, I want to save this search, and we'll just call it Groundhog Day Long Puts BB. Okay. And why did I go through that? Because now that we've saved it, let's just see how this might have worked out for us back in December through a 40 to 45 day period to the next expiration, or from January into February. So this is a trial account that we use for our webinars, and during the trial you have about 3 months of access to the historical tools, the historical search by symbol, looking up positions by strategy, one stock at a time, or the SmartHistoryXL, which works the same way as the search that we just saw, but it scans across the universe of options to find positions that match your criteria on a date back in time that you select. Of course, you also have 3 months of data to the historical option chain. Those are the 3 main historical tools that we have on PowerOptions. But now that I've saved my search, let's go into Smart History. And I'm going to go back to December. Let's see how far back we can go. It's probably to the 2nd or 4th. Okay, great. So go back to December 4th. And we're going to look at our Groundhog Day Long Puts Bollinger Band. Now, this was before the big run up at the end of December, so we should find some reasonable positions that were in a decline that had that consolidation period of the Bollinger Bands, as well as being in the middle range. Now, I apologize that it's taking a little bit extra to snap in. The reason why is because right now, our historical data is based on a snapshot of everything at the close at the end of the day. So right now, the data tables are being loaded by all the historical data from today's end of day run. Okay, but we've got Microsoft in here, ConocoPhillips, AMD. Oh, that's probably not going to be a good one. But we've got, let's see what the stocks look like at that time. Let me just take Cheniere and let's go to Big Charts. Okay, now, Big Charts doesn't know I'm in the history. So I've got to extend this back. So in December 4th, now we're right in this time frame. Here's where we were in December 4th, December 2nd, December 3rd, December 4th. So we're in a downtrend. They're condensing a little bit, but this Bollinger Band range seems a little bit wide. And this stock snapped up, but it did come back down. I don't think that's going to result in a profit. And we're going to look at how all of these performed. These are all out, 46 days to that be January standard expiration. Where was Microsoft at the time on December 4th? Okay, so this one's actually, I looked at that wrong. Here it is. I was looking at November 4th. My apologies on the last one. But here's December 4th. Consolidation period of the Bollinger Bands. Stock in a 1 to 2 to 3 day downtrend. That's where we are for December 4th right now. Let me clear this up a little bit just so we can see it. I'm going to take out the volume and the RSI as well. So let me redraw that chart. There we go. And so now we can see, yeah, here's December 4th, and that's pretty much where we were, right here. But this didn't really work out. It stayed in this consolidation period, and then boom, it just began to ramp back up. That wouldn't have been profitable for a long put position. Doesn't mean it's always the case. Let's take a look at the next one, Campania. Let's just look at that chart. There we go. Now, this one would be much better. So, where are we? Oh, I'm sorry. I have it saved this way. Sorry about that. Let me change this, and that way I won't have to keep doing that. Let me just store the chart settings here. There we go. Sorry about that, folks. All right, fantastic. December 4th, where are we? Consolidation period of the Bollinger Bands. 1.5, 2 days of a downtrend. Getting that consolidation here. It's also right in here. Might have been a good time, but you got this ramp up and then this huge decline down later. So by January 19th expiration, the potential here for a good profit on the position. All right, so we're not going to go through all of these. We're going to do something much faster, but I just wanted to take a look there to see if it was giving us the charts we was. And yes, it was. I just looked at the first one wrong because I thought this was going to be our December period, and it wasn't. That's the November period. Well, now that I've got my results, it's the top 30 of 253 results. Let's just calculate group results. Let's see how these all performed to standard January expiration. And we've got a lot of mixed bag of information here. We've got some that are near full loss at 100%. We expected that with the Microsoft chart we saw. Any of the Microsoft positions, we would have only taken one of them, not all three. But they were all near full loss. Actually, let's narrow that down again. What I'm going to do now is just take one result per security. I probably wouldn't have bought multiple strikes for Microsoft. I should have done that in the beginning, but I want to see how many we got. So now we've got it down. There's one result per security. It looks like now let's calculate the group results. So we don't have 4 Microsofts at 100% loss, but we still have Green Plains. January 15th strike. The stock was at 1265 on December. Stock stayed at 1231. It didn't move. Now, you can say, well, did it ever have a profit during that time period? Let's take a look. I'm going to analyze position for Green Plains. This is going to show us the high and the low, the chart of the option price and the stock price over our trading time period. The max return was 2 days after entering the trade at a 30% gain. That's a great gain. But for buying puts or buying calls, I'm not sure if that would be your target to close. It's definitely meeting your annualized goals. I know that. But most investors I talk to who are buying calls and buying puts, they're usually looking for 40, 45 to 50% gains minimum. Some have a higher target of 75 to 80% gains on their winners if they're more speculative, with cutting the losers to maybe only 40%, 45%, or 50% of the price they paid. But again, there was potential for return 2 days into the trade. But shortly after that, it was never in a winning mode. To get back up here, just about break even on 1226. Oh, maybe we did have a small profit up here. You probably, if you held it this long to 105, you probably would have gotten out with a 12% return just to get anything you could off of the position. But just the last 5 days, 10, 14 days, it went to zero value on those positions. And you can see the option price compared to the stock price as well. We know Microsoft didn't have any gain when we looked at that stock chart. The stock just kept moving up. Oh, biggest gain was on 1214. I do apologize. 6.8%. You probably wouldn't have closed it then. And 2 or 3 days after you're in the trade, you're down 30%, 31%, 37% on 1212 before it had this big jump, but only up to that 6.87% return and then declined down. Okay. So yeah, with the historical tools, you can see the return expiration. Don't get me wrong. We had some big winners there. My apologies. We had some big winners there. 145% with Cheniere. That's the chart we looked at, isn't it? We saw that it was there. But LNG went from 174.17 down to 161.05. Option price of 805 on December 4th to 1975 at the end. And actually, the return was probably higher than that sort of on. But Murphy Oil Company, 156% return. But only 12 out of 30 were winning trades, 40%. And the average loss was 12.7%. But that kind of makes sense, doesn't it? Because during that time period, QQQ was up 8.3%, SPX was up 5.6%. We were in a strong market, an upward moving market to that period at the end of December going into January. Let's flip the script a little bit. Instead of December, we look to January 19th. What if we had opened positions on January 19th, the day after the 19th expiration, the 22nd, I believe, using our Groundhog Day long puts Bollinger Band screen. I didn't grab it right. There we go. Okay, the 22nd. So this is just after the 19th expiration, the Monday or Tuesday following the Monday expiration as the market was closed. So let's go ahead and run this and see what stocks we get. I'm going to re-add in that one result per security to limit our analysis. We've got Caesars Entertainment, Planet Fitness, Northrop Grumman. All right, let's do that check result again. One result per security. Narrow that field down just to one strike to each of the underlying securities that matched our Bollinger Band requirements. Starbulk, that should be interesting. Starbulk Carriers, dry bulk shipping. Let's go ahead and calculate our group results for those positions. See anything else interesting in here? There's a lot of Wynn Resorts is in there, okay? Lionsgate, Canadian Pacific Railway. Not a lot of big names in that list, though. And here we do a little bit better. 15 out of 30, or 50% are winners. Loss of 5% overall. Now, the top 4 of the top 5 were winners. 50.9% at Caesars, Planet Fitness at 101.8, 93.4% from Northrop Grumman. BlackRock is break even, but we did lose 90% on the ETF XLP. So 2 months does not the market make. These examples, you're going to be using slightly different criteria and adjusted criteria. I'm just showing you this because we saw a couple positions that had the stock chart that we wanted at the time that we were going to enter the trade. And this is for the January position going into February. We're not there yet. We still see more. But on January 22nd, I know it's just a few days ago, week and a half ago, you're in that period that you were looking for. Here's your consolidation, and the stock has been declining for 3 days, and then it just ramped up afterwards. It's nowhere near expiration. We still got another 14, 15 days to that February expiration, Scott, but this one had to bounce back up. The other ones, of course, will see the same thing, but a different outcome. Let's go to charts. Let's go to big charts for a big winner there, Northrop Grumman, I'm sorry. And there we have some kind of big major move, don't we? But now here's the other factor. Here's the 22nd. What do we have? Stock down 4 to 5 days, the condensing period you're looking for, and then on the 25th, boom, there's your big return right there, dropping from 470, 465 down to as low as almost 425 before it came back up to 435. That looks like it was on the 25th of January. Now, why that's important to me is I want to see something else. You may or may not be checking this. Oh, I wanted to go here. Sorry about that. So I have the research link here. I apologize. Let me just go to the option chain real quick. I want to go to the research tool. And this is a quick way to do it. So I want to go to the stock research tool. So on January 25th is what we were looking at. And that's why. That big move was due to the earnings, not the technicals. It was due to the unknown outcome of the known event. And the poor earnings is what caused the profit on the position, not the lead in by the technicals. However, if you're looking for that kind of play, Scott, in addition to what you're doing with your the Bollinger Bands and the squeeze that you're looking for, you could always choose to look for stocks that have that earnings date between now and expiration. What did we have here in our search? 30 out of 98 results for the January 22nd selection. Adding in that earnings requirement, knocked it down to only 32. Northrop Grumman, Starbolt Carriers, Canadian Railway. Let's take a look at these. Narrow down the grouping a little bit more. Maybe we'll see some better results. Not exactly. It's still a mixed bag. 43% success rate, 7.4% average loss, or average percent return across a portfolio if we opened all of these positions. And of the first 4, 2 out of the 4, 50% are losers, but with the one Northrop Grumman gain of 93.4%, probably would have balanced out the losers. Let's take out everything else but those top 4. Of course, you might be using a different sort and not seeing them in that order. Yeah, so this would have been a 50% with a 22.7% return, taking the 24% loss, 16% loss, 38% win, 93% win as well. Assuming even money is added into each position, or the monetary gains for each one. Some of them are very small, some of them are very big. So, all right. I'm not trying to downplay your idea, Scott. Not at all. What I'm trying to say is that we want to look at these things in conjunction with other things naturally. You're still going to do your due diligence, I understand. But for the search capability, that's what we wanted to look for there with those settings, the percent bandwidth in that 35 to 65 range, percent bandwidth 20 less than 15, stock price below the 20-day moving average, number of days stocks down 1 to 3. And then you can toggle what you want with your expiration time frame, the implied volatility range, you're not overpaying for the option, and your range in or out of the money that you want to use, or perhaps the delta that you want to use as well in those cases.